we have been having discussions on the traditional way of investments. Long only, we have heard so many speakers talking about their styles. I'm just going to speak something slightly different, uh, more on the alternate side, how the evolution of the alternate industry globally and how it has grown from a, from a place of, uh, you know, not a significant industry to something significant in the global space, and what it holds good for India. In fact, all of us are traditionally long only managers. We have been seeing, like today we are sandwiched between one side alternate industry, on the other side by the passive funds. The business is getting commoditized. One interesting thing is, in the last 30, 40 years, in spite of the alternate industry growing, uh, today it's about 16, 17% of the total asset management industry, which is about 74 trillion. The profitability of the alternate industry has stayed very strong. That's what we saw in the morning presentation from Anup. It's creating almost 40% of the total asset management profits globally. So that's the background under which the global alternate industry is growing, and India is something which it can look forward, because today we are all in the same space where we're getting commoditized across in the long only, and there's a fantastic opportunity for us to grow. And with the evolution of AIF as a platform along with PMS, potential is very large for us to grow in this business. In fact, I'll take a little bit of data plus one bit of story to take over the next 20 minutes to cover this industry. Actually, if you look at traditionally in the 1900s or before that, it was always investors preferred physical asset as against investing into stocks. And as they went along, they realized that it's not easy in terms of liquidity, and they've thought that they need to innovate. And post 1920s, we saw people, investors, as well as the fund management innovation happening by investing into common stocks, which had the opportunity of being more liquid. What happened in the as people invested in the common stocks, more funds were launched, but they also realized that volatility was one key thing which was making the portfolio go down faster in terms of market when there is a bear market coming in. Mind you, the cycles were large those days, not like today. So people started suffering in terms of volatility, and also the returns were very correlated to the typical indices or index. So they thought that they need to innovate. Again, investors preferred something which is less volatile and uncorrelated returns. So slowly things started happening. Emergence of alternates came in. Like, what is alternates? Basically away from traditional. Something which is not traditional was called alternates. And that's where alternates came in to being, to reduce volatility, to come with uncorrelated trade. At the same time, they wanted to have a better risk adjusted returns and create more alpha compared to just a long only common stock investing. And today, the alternate industry, as I mentioned, which is about 16% of the total asset management industry, consists of these type of asset classes. Typically, the hedge funds, the long shorts. Then we have the private debt. Then we have real estate infrastructure. Of course, natural resources in terms of oil, commodities, and private equity. Each one is growing in a big way, and from a periphery, they have moved to a center stage in terms of global asset allocation. In fact, there is one interesting story which I just wanted to talk about, how alternates came in. Actually, it all started from one individual who is an Australian born, moved to US. His name is Alfred Winslow Jones actually. He started the first hedge fund in 1949. Interestingly, his background was not an asset management background. He studied in Harvard, and he went and worked as a US Foreign Service. He was a ambassador to Germany, and then he came back and did doctorate in Columbia University doing sociology. Interestingly, when he was studying something on the sociology topics and he was writing in Fortune, he was trying to do something on forecasting of fashion industry. He was trying to forecast the fashion industry, and then he suddenly bounced upon the technical analysis of stock market on the Wall Street, and that's what how he started understanding the uh, way of style of investing, and then he realized that he can leverage and do shorting of stocks, and that's where how the first hedge fund was started. He started his own company, and then he started the first hedge fund in 1949, and then we have seen the alternate industry growing. What has happened is actually 1970s was the first boom in the hedge funds, and then it crashed because of the oil crisis and inflation was high in US. But we have seen across cycles, every 10 years, whenever the common stocks or the long only market was going under bearish phase, the hedge funds grew phenomenally. We have seen George Soros type of gentleman creating macro funds in 90s, made a lot of money. So this is what how we have seen the alternate industry growing. And significant growth was after the dot-com burst and then the global financial crisis. These are some of the classes of alternates compared to the traditional asset classes. And this is what the industry I'm talking about, how it has grown. Say last 15 years, in 2003, alternate industry was about 10% of the $31 trillion asset management industry. And today, it has grown to almost 16%. What has happened is at the expense of the long only funds, it has grown in that way. In fact, I will tell you some of the case studies we have done, how the industry has grown. That's a big story for us, how to grow our alternate industry here. We can see how they have outperformed the long only at various cycles, including at various points of crisis. This is what we have seen the last 15 years, why this alternate industry has grown, especially after the global financial crisis. In fact, we have seen a couple of things. One, this business has become more institutionalized. Today, almost the alternative business is funded by typically pension funds, endowments, insurance companies, and somebody who has a long-term capital. In fact, it's almost 75%. I have a slide to show you. It's almost 75% of the alternate industry being funded by the long-only patient capital money. And we have seen how the hedge funds or the alternates have also innovated. They have innovated at every point of time. Whenever the long only markets or the stock markets went into a bear cycle, the hedge fund industry or the alternate industry have come out with interesting innovative ideas which has helped the industry to grow and created higher alpha. In fact, what we see over the next 10 years or even next 5 years, we see a tremendous growth in the industry. In fact, it is coming at the expense of the long only funds. This is what the growth story is. We are seeing almost an 8% CAGR in the alternate industry compared to almost 5% in the traditional asset growth. In fact, the biggest growth is coming from you have more of natural resources and the investments like infrastructure, where the long pension funds, endowments who want to lock in longer term of money, but they want consistent returns to take, they have a deficit in across other asset classes in terms of returns. They would like to lock in long-term infrastructure. That's where more growth is happening from the institutional space. And this is what the pan-global growth and what in terms of the size of the alternate industry. US by far is much bigger in terms of asset size, almost 27 trillion. But what is interesting, if you see even Hong Kong, where the hedge fund industry started almost 25 years ago, is only at about 108 billion compared to India, which is like more of a 6 to 7 year after the regulation came in. We have seen the industry growing. is catching up quickly at about 42 billion today. But so India has a potential to grow compared to many parts of the world, and of course US continues to lead the growth of alternates. Coming back, I just wanted to carry a few slides how India can help from the learning of the global experience in the industry, alternate side. Today, India, we all know that we had the SEBI coming with an alternate regulations in 2012. Before that, it was typically the 1996 venture capital regulation which was in place. But today we have AIF has three, all of us know. Category 1 typically is more of infrastructure, private equity and venture capital. Category 2 is more of debt side, real estate and private credit. And then you have category 3, which is more of equity, long short, derivative using leverage. So we still have, we have started. In fact, in the morning, Anup was mentioning the asset allocation from the wealth side is just about 3% in alternate space. So the potential to grow is very large. I just wanted to show you how the alternates have grown internationally, which is a story for us in India going forward in the next 10-15 years. This is the way the industry has grown. Downside protection in terms of lower drawdowns. Secondly, volatility has been controlled much better than the long only investing. Thirdly, better risk adjusted returns. And then we have also seen, as the industry grew from one crisis to another, regulations and transparency has increased in the industry. And as I said, institutionalization has also brought about a dramatic change in the industry. This is the first point which I talked about, this maximum drawdown being lower. This is a case study for us, for the Indian alternates to grow. Look at the various time frames. We have taken, as of September 30, 2019 data, we have done a 5-year daily rolling return of S&P 500 index versus the global hedge fund index. We have also done on a monthly 10-year rolling return, and for the last 20 years. What we have seen across various time frames, the S&P 500 index, the equity side, had large drawdowns across various time frames. As against the hedge funds, you see that the amount of difference between, for example, 5-year it is 19.8 minus 11 versus 11. On a 20-year, it is 38 versus 23. This is a huge, that's what the hedge fund can create value for investors. Look at the right side where we took certain crisis points in the last 20 years. One is the 2007-8, the global financial crisis, which all of us know, one of the worst crises we have seen globally. During that time frame, in fact, interestingly, when I read those times, the press went on saying that this crisis was created by Lehman, of course, and then it spread out, but it was led by the hedge fund industry. That was the story. But actually, post that, when you see the data, hedge funds have come out winners compared to the traditional asset classes. You see that S&P index the drawdown was almost 52% versus the hedge fund index having a lower drawdown at 26%. Same way we had the Asia crisis, 97-99. Again, same story. MSCI Asia Pac index was down almost 48.3% versus the hedge fund at around less than 3%. So what is story for us? Alternates can protect your downside when the markets are not in your favor. The second point is on the volatility. Again, very interesting statistics. We saw that over the last 5 years, how the S&P 500 versus the hedge fund index has controlled the volatility. Very different. You look at the green line and the red one. Very clearly, you can see the difference between the S&P 500 versus the hedge fund index. The same story across in the global financial crisis. Much lower volatility compared to the S&P 500. In terms of risk-adjusted return, again the same story. Very large difference between, on a 10-year Sharpe ratio between a hedge fund versus an S&P 500 index. I've taken the S&P 500 being the best of the bench on a broad index globally, well understood, well followed. So you look at the difference, the hedge fund's value creation on a risk-adjusted basis, which is again very important for us when you want to attract more assets in the time to come in the Indian market. The other point which I want to say, which we are also in throes of, regulatory changes across in the AIF space and as well as PMS. PMS is around the corner. AIF may not be far away in that. We have seen globally the same experience, especially after the global financial crisis. We have seen the lot of changes in the global regulations. What it means is the investors get more transparency in terms of more frequent reports, quarterly, annually, and more disclosures as bound by the regulations. And interestingly, there are other detailed ones on in terms of conflict of interest, more disclosures, as well as on the risk side, which is very essential to look at compared to a traditional long only fund investing. The other important thing which has happened, which has helped the industry to grow more institutional, is the more transparency of data. Today, the institutions before investing, like a pension fund or an endowment fund globally, has more data to do their due diligence, and they have much more concrete one before they invest and asset allocate. So these are some of the last few slides where we are. This is what how institutional, the business has become more institutionalized, as I mentioned. In 2002, the institutions were contributing about 20% of the assets under the alternates. Today, it has grown to almost 65%. 65% in 2013, and now it's about 75%. So today, the industry is almost 74 trillion, out of which the alternate space is about 13 trillion, and 74% is contributed by institutions. In India, we just took India, the data is sketchy, but whatever the data we have, India is not lagging behind in terms of the investor mix, though it is predominantly we are seeing in long short more high HNIs, but in other forms of assets like infrastructure, real estate, we are seeing more institutional allocation in this alternate side. This is what we see way forward. In fact, the introduction of AIF is a fantastic structure for raising long capital. This is a very interesting compared to a PMS. Of course, we at Sundaram we do both PMS as well as the AIF, but I see AIF is something which you can attract a large amount of capital with a better structure, and more institutions can participate so that the industry can grow in a systematic way. And we see today, like, there is so much of opportunity in the Indian market. The last 5 to 10 years, we have seen the way distress has happened in the corporate sector, also in the real estate and various other forms of industry where there's so much of distress. AIF can be a fantastic structure to raise institutional money, long-term capital, both domestic as well as international money. So I see that as a great opportunity for all the players in this space. And also, of course, we know that this 5 trillion target, which we all talk about, again, this is a good pooling structure. AIF being a good pooling structure can really create more long-term capital it can attract. That was my last slide. Thank you very much for the opportunity.